Hello, investors. This is Edwin Epperson with Blue Bay Fund and Blue Bay Capital. Today's article, I wanted to cover what are private notes. They are secured investments that throw off reliable cash flow. So, what are private notes? As John D. Rockefeller has famously once said, own nothing and control everything. And this really speaks to the mindset of a lender. We control the asset through secured lending, but we don't take on the liability and responsibility of that asset through ownership. So we're going to cover notes, which are loans. We will also cover secured lending versus unsecured lending. We'll cover active versus passive investing, and then Blue Bay customizable solution. How is it that we are working with passive investors to diversify into notes secured to property? So what is a note? A note is a physical representation of money that a person or an entity loans to another, with an expected date of return on the principal along with a rate of return on the loaned capital. This is called the APR, or annual percentage rate. In this case, we have a person or an entity with money that wants to loan it to a borrower. The lender loans the borrower their capital, and in return, the borrower signs a promissory note that the lender should create and gives it to the lender at the same time that they receive the capital from the lender. The note is a physical representation of the lender's capital. Now, the lender needs to keep this note in a safe place, probably a fireproof safe, because it is a legal form of tender. That's right. The lender can actually use this note. They can sell the note. They can borrow against the note, also called hypothecation. So that piece of paper that is actually a physical representation of the amount that that lender has loaned. The age-old question in lending is really, is the note secured or unsecured? If the borrower were to use a credit card, this is a form of unsecured lending from the bank. Now, in this example, the bank, private lender, but we'll say the bank because private lenders typically don't create credit cards for their borrowers. So the bank is going to offer, a credit card or maybe a line of credit, also known as an LOC. There's no underlying collateral. The loan is given to the borrower simply based on the borrower's credit and the bank's belief that the borrower has the capability to repay. However, if the borrower does not pay back the credit card or the line of credit, then there's really nothing else that the bank could do to recover their money. The bank may choose to take the borrower to civil court if the amount is great enough, and the borrower's credit will most likely be ruined. But beyond that, there's really no other way for the bank to recoup their funding, and the bank cannot just go out and take the borrower's assets if they are filing a lawsuit against the borrower for a unsecured loan, unless they go through a lengthy court battle. And then, of course, the borrower always has the ability to declare bankruptcy. Let's look at the other side. The borrower owns an asset. In this example, it could be a house, but really it could be any asset that the lender finds of value. The borrower pledges the asset in exchange for the lender's capital. The lender loans the borrower the money. In exchange, the borrower signs a note, also called a promissory note, because the borrower is promising to pay it back. And these terms are interchangeable, note and promissory note. And this is where the key difference is. At the same time that the borrower signs the note and receives the money, the lender also has the borrower sign a mortgage or a deed of trust, and this is really state dependent. The lender records the mortgage or the deed of trust in the county where the property is located. And this mortgage or deed of trust is also called a security instrument because it secures the lender's note to the asset. Now, if the borrower does not pay back the lender or the borrower violates the mortgage or deed of trust in any way, the lender can take the whole asset for whatever the lender loaned. And hopefully the lender was wise and loaned less than the asset was worth. And therefore, they could actually make more money in a worst case scenario. Let's take a look at what would happen in the case a borrower does not pay on an unsecured loan. So henceforth, the credit card. The borrower was paying, and then, of course, life happens. They stopped paying. Now that the borrower stopped paying, the lender becomes very upset. They lose a lot of sleep, and they're probably really stressed out. What happens now? Well, in an unsecured loan scenario, the lender and the borrower, they have to go to court and they dispute their case, and ultimately the courts will decide what is to happen. This can be a lengthy and cost-prohibitive process, not even counting the legal fees. And at the end of the day, the lender may get a judgment against the borrower, or they may not. If they do get a judgment, they may be able to garnish their wages, or they may not. However, the borrower always has a nuclear option, and this is to simply file bankruptcy. In a bankruptcy, the courts will look at all the borrower's ability to pay back all of their debt, and the courts will decide how much of each unsecured debt the borrower must pay back. And typically, this is at a pretty steep discount. So the lesson here is do not lend unsecured capital. Make sure your capital is always secured to a hard, tangible asset. Speaking of which, here we've got a lender. They've collateralized, meaning they've secured their note, which represents money loaned to the borrower. They've secured their note to this collateral via a mortgage. Same process. The borrower's making their monthly payments, and then all of a sudden, life happens. They stop paying. What does the lender do? Well, in this case, the lender can sleep soundly at night because all they're going to do is take their mortgage and their note and to go to the courts and sue the borrower. This is called foreclosure. How long will it take? Well, it's state dependent, and it really depends on whether it's a judicial state or non-judicial state and how long it takes to get through the courts, through the process of the court. But at the end of the day, that mortgage secures the private lender's notes, which is representative of the money that they loaned the borrower. And because of that security, that lender is protected. And due to this security instrument, the mortgage, the lender is guaranteed to get the property after foreclosure. I mean, it is a guarantee, which is why secured lending has no other measure of safety when compared to unsecured lending, and even more so when investing for generational wealth. I do want to caveat this. It is guaranteed if the lender is in first position, which is a whole different discussion for another day. You can have there are different positions on title which a lender can have their mortgage or deed of trust recorded, and position is very important in the case of a foreclosure. But in general terms, a secured loan is always going to be safer than an unsecured loan. The last question you should ask yourself if you're looking to get into private lending is, do you wish to be an active private lender or a passive private lender? Active private lenders must communicate and build a team that protects them throughout the entire loan creation process. The active lender must know how to vet each one of these actors in a loan file, as well as the language and the timing of when to request, review, and make decisions on the loan being made. This requires a dedication of time and continuing education that is not for a part-time private lender or somebody that's looking to just dip their toes in the water. This is basically, it is a full career development. On the other hand, the passive lender is someone who identifies a broker or an active lender and lends through them. They are able to take advantage of true leverage by leveraging the active lender's time, knowledge, and experience. They can passively participate in private lending without having to worry or be concerned about setting up and running an entire private lending company. Let's discuss BlueBay's customizable lending solution. If you simply don't have the time to make these investment decisions, BlueBay works 24/7 in this investment space. Maybe you don't have the experience to properly vet and underwrite these investments. Well, BlueBay does. You may want true passive income with the risk mitigation that only private lending offers. Well, BlueBay provides monthly file cabinet money to our partner investors. You may have been looking for a different way to leverage, not just capital, but knowledge, time, and experience. BlueBay welcomes investors seeking a true partnership. And you get anxious, maybe making a multi-$100,000 loan or even more. BlueBay specializes in offering unique and one-of-a-kind partnerships to its investing clients through our customizable solution. The question you should really be asking yourself is BlueBay's customizable lending solution right for you? Well, if you are seeking hands-off investment options and passive income, if you are looking for a way to diversify your portfolio outside the traditional low-yielding bonds and dividends, and if you are interested in alternative investments where you think, analyze, and invest like the banks do, well, then BlueBay has a solution for you. My name is Edwin Epperson, manager of BlueBay Fund 1 and BlueBay Capital. I'd very much appreciate being able to connect with you on any one of my social media platforms you can see here. You can schedule a call with me on our website as well, or reach out and request a phone consultation to discuss how BlueBay can help you build, protect, and preserve your family's generational wealth. Thank you. God bless, and have a great rest of your week.